The CBOE Volatility Index, better known as the VIX, once again sitting near record lows, closing below the level of 9 for only the third time ever. Wald with Oppenheimer, Eddy, Elfenbein with AdvisorShares. Ari, we could have the debate about whether or not the VIX is a good measure of volatility anymore, given some structural changes in the options market. Let's assume for this segment that it is still a good measure. What is a sub-9 VIX telling us about the future of any market anywhere other than there's no volatility?
Well, for us and talking to a lot about the VIX in recent months and recent years, we found that it's a very misunderstood indicator because there's an asymmetric payoff. You can buy equities when the VIX spikes. It tends to be a good signal of short-term market lows and heightened fear in the market. But you can't sell equities just because VIX is low. That historically, VIX can stay low throughout the course of a bull market. In fact, we found it is a characteristic of a healthy advance. The time to get worried is when the VIX is rising with the market. And even if you look back through history, at the market top specifically in 2000 and 2007, the VIX was already above 20 at both those points when the market was making highs and ultimately topped out. And if you run the numbers on it as well, forward returns on the S&P based on the level of VIX, when you're in that 20 to 30 range, that's the category you don't want to be in. That's when you tend to see below average returns. So as it stands now, I don't think it's necessarily bad for the market, and I think you want to buy stocks when you do get those little bit of spikes in the VIX.
Eddy, I'm going to paraphrase Ari, even though he's still here and can hear everything that I say, which is basically, it sounds like what Ari's saying is ignore the VIX until we start sniffing 20. Then you pop your head out of the hole and go, okay, what's going on? Would you agree with that?
I would agree with part of it. In fact, I would extend it more. I really think that the VIX can be ignored by a very large percentage. The thing is that volatility is not separate from the market. When we go up, volatility goes down. When we go down, the volatility goes up. Basically, what the VIX says is how strong is the current trend. If we're in a trend, we're locked in that trend. We see what the Fed is going to do. We see where earnings are going to be. That's when you see the VIX is very low. So I agree with once that starts to break down, you will see the VIX rise, all of those things, and you'll see the market start to break as well. Like Ari, I agree. Once you see a divergence between the two, with the market staying the same, the VIX rising, or when they're both rising together, that's time to get a little worried. But for right now, I think it looks very good. We have these strong trends in place, and I think we're going to continue to see low volatility.
So, Ari, did I paraphrase you correctly? If we get to around 20, we start paying attention.
That's right. As it stands now, what we're seeing consistent with a healthy bull market.
All right, yeah, which is, I guess, maybe the VIX is working. It's low. The Dow's up 30 every day in, day out. Eddy and Ari, thank you both very much. Appreciate that. And when and if the VIX ever gets back to 20, who knows if it does, we're certainly going to do another segment on it. Thanks for watching Trading Nation. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.